Bank runs can have systemic effects on the financial system and the economy, such as triggering more bank failures, disrupting credit markets, and reducing consumer spending. In this section, we will explain how these effects can occur and why they are harmful. A bank run occurs when too many customers withdraw all their money simultaneously from their deposit accounts with a banking institution for fear that the institution may be, or will become, insolvent. A bank usually only has a limited amount of cash on hand that is not the same as its overall deposits. So, if too many customers demand their money, the bank simply won't have enough to return to their depositors. This can create a vicious cycle of panic and distrust, as more customers lose faith in the bank and try to withdraw their money before it is too late. A bank run can push an institution into bankruptcy if the bank cannot maintain a regulatory equity requirement. Regulators must then step in to ensure an orderly return of depositor funds and to mitigate a broader panic. But why does a bank run affect other banks and the economy as a whole? The answer is that banks are interconnected through various channels, such as lending, borrowing, investing, and trading. These channels form a network of financial relationships that can transmit shocks and contagion across the system. For example, if a bank fails due to a run, it may default on its obligations to other banks that have lent it money or bought its securities. This can cause losses and liquidity problems for those banks, which may in turn face runs from their own customers or creditors. This can lead to a cascading effect of bank failures that can threaten the stability of the entire banking system. Another channel of contagion is through the interbank market, where banks lend and borrow money from each other to manage their liquidity needs. A bank run can disrupt this market by reducing the availability and increasing the cost of funds for banks that need them. This can impair the ability of banks to lend to each other and to other sectors of the economy, such as businesses and households. A disruption in credit markets can have negative consequences for economic activity and growth. Credit is essential for financing investment, production, trade, and consumption. Without access to credit, many businesses may have to cut back on their operations or even shut down. This can lead to lower output, income, employment, and profits. Similarly, without access to credit, many households may have to reduce their spending or postpone their purchases. This can lead to lower demand, sales, and prices. These effects can create a feedback loop that amplifies the initial shock and prolongs the recession. Therefore, bank runs can have systemic effects on the financial system and the economy by triggering more bank failures, disrupting credit markets, and reducing consumer spending. These effects can be costly and damaging for society and welfare. That is why preventing and managing bank runs is a key challenge for policymakers and regulators.